Hey everyone, and welcome to The Explainer. Today, we are demystifying what is honestly one of the most critical financial decisions you're ever going to make: navigating the absolute maze of U.S. retirement accounts. Look, if you've ever felt completely overwhelmed by the alphabet soup of 401ks, IRAs, and HSAs, you are definitely in the right place. We're going to break these tools down logically so you can actually build a strategy that works for you. Okay, let's dive into this. Over $100,000. Seriously, no exaggeration here. Choosing the right retirement account and strategically playing its tax advantages can potentially save you hundreds of thousands of dollars in taxes over your lifetime. This isn't just about saving your pennies, it's about keeping what you actually earn and letting it work for you, rather than just handing it right over to the IRS.
So, that brings us to the core problem we're tackling today. Taxes and aging, yeah, they're basically the only two guarantees in life. But how you prepare for them completely dictates your future financial freedom. By the time we wrap up this explainer, we're going to shift your mindset from feeling totally overwhelmed by complex tax codes to feeling incredibly empowered. We'll figure out exactly which buckets to put your cash into so you avoid falling into a lifetime tax trap.
All right, part one, employer plans and free money. Let's look at the first set of tools in our financial tool belt.
I need to be absolutely crystal clear on this first step. Ignoring your employer match is literally leaving free money on the table. Every single year, Americans leave billions of dollars in unclaimed matching funds just sitting there. If your employer offers a 401k and promises to match a percentage of what you put in, that is quite literally free money. It's an instant 100% return on your investment the second it hits the account. Ignoring this is, for sure, the biggest unforced error you can make.
And this brilliantly illustrates how these foundational tax-deferred tools kind of shift depending on your actual profession. The 401k is your standard for corporate folks, but if you're a teacher or in the nonprofit sector, you'll probably see a 403b. Government employees, you're usually looking at a 457b. But here's the thing, while they cater to different jobs, they all share this one superpower: they are tax deferred. You put money in before taxes hit your paycheck, lowering your taxable income today, and then that money grows tax-free until you pull it out in retirement.
Moving on to part two, the great IRA showdown. Once you've snagged that employer match, it's time to step outside the workplace.
Now, what's really interesting about this slide is the sheer contrast and strategy here. With a traditional IRA, you get this awesome immediate tax deduction today, but you're going to pay taxes when you withdraw the funds later. Plus, the government forces you to take required minimum distributions. Basically, they make you take money out later in life just so they can finally tax it. On the flip side, the Roth IRA is the exact reverse. You pay taxes on your money right now, but it grows tax-free, and your withdrawals in retirement are completely tax-free. It boils down to tax now or tax never.
To kind of ground those abstract rules, let's picture two different people. Imagine a 25-year-old starting their first job. They are, without a doubt, in a lower tax bracket today than they will be in retirement. For them, eating the low taxes now to fund a Roth IRA is a no-brainer because decades of growth will be totally tax-free. On the other hand, imagine a high-income professional in their peak earning years. They're getting absolutely crushed by taxes right now. They desperately need the immediate tax deduction of a traditional IRA to knock down their current taxable income. So your current income really dictates your whole IRA strategy.
Part three, hidden gems and niche accounts. We've hit the heavy hitters, so let's pivot to some specialized accounts people often miss.
Meet the absolute secret agent of retirement planning, the Health Savings Account, or HSA. I know it sounds like a basic medical account, but it is secretly the ultimate retirement vehicle because it packs a triple tax advantage. Number one, contributions are tax deductible. 2, the money grows tax-free. And 3, withdrawals for qualified medical expenses are completely tax-free. Literally no other account gives you all three. Smart investors use this specifically as a massive shield against long-term healthcare costs in retirement.
But hey, what if you don't have a traditional boss? Freelancers, self-employed folks, and small business owners actually have some incredible options. The SEP IRA and the solo 401k let entrepreneurs stash away massive amounts of money, way more than a standard employee could ever put into a regular 401k. These high-limit, specialized accounts are exactly how business owners can rapidly build some serious wealth.
Part four, the magic of compounding. We know the tax rules now, but let's look at the underlying engine that makes all of this go.
Let's move to and see how this builds. The math here is honestly just staggering. Look at someone who starts investing at age 25 versus someone who waits until age 35, because the 25-year-old's money has 10 extra years to compound. Where the interest literally earns its own interest, they end up with drastically more wealth. And that's true even if they contributed the exact same total amount out of pocket. Starting early is, without question, your greatest asset.
Part 5. Avoiding common retirement traps. Because let's face it, even with time on your side, things can go sideways.
All right, rapid fire through these 7 major traps. We already talked about ignoring the match and waiting too long, but I really want to warn you about early withdrawals. Tapping into these funds before age 59 and a half usually triggers severe tax penalties. It essentially robs your future self. Also, make sure you're diversifying your investments inside these accounts. And super critical here, designate your beneficiaries. You want to make sure your wealth goes exactly where you intend it to, if the unexpected happens.
Part 6. Your step-by-step roadmap. Let's pull all this theory together into a concrete, actionable master blueprint.
So the crucial point is having a rock-solid sequence of operations. Step 1, build that emergency fund first so you never have to touch your investments. Step 2, capture every single penny of your employer match. Step 3, maximize your Roth or traditional IRA depending on your current income. Step 4, automatically bump up your 401k contributions every time you get a raise. Step 5, keep it simple. Invest long-term in diversified, low-cost index funds. And Step 6, just review your accounts once a year to make sure you're on track. Follow this blueprint and you're assembling a totally bulletproof financial tool belt.
Ultimately, crushing it in retirement doesn't mean you have a crystal ball for the stock market. It's about starting early, staying consistent, keeping your fees low, and utilizing these tax codes that are literally designed to help you. You've got the blueprint now. You know the rules of the game. You can't time the market, but you can absolutely control when you start. So the only question left is, which account will you open today? Go take action, and I'll see you in the next explainer.